In this video, we will discuss one of the most powerful concepts in analyzing the market, the four phases. The four phases of the market have improved my analysis of US 30 and other instruments in a big way. If you analyze the market through the four phases, you will be able to participate in bearish and bullish trends more confidently. You'll be able to participate in reversals and recognize when to sit on the sidelines and wait. The concept of these phases apply mostly to indices and stocks, but you'll also find them in the Forex and commodities markets. By identifying the current phase, you will be able to see where big institutions are and be able to ride the wave with them. Let's jump into it. Let's get into the four market phases. The market can be broken into four price cycles or four phases. This applies mostly to stocks and indices, but you can see the same or similar behaviors in the Forex markets and commodities. The reason why we need to study these patterns is these phases will help give us context for the structures that we're looking at. We're going to talk about the structures pretty soon, the different market structures, the different zones, the different candlesticks. From a high level, if you can understand what phase or what stage the market is in, then it'll help you when it comes to the level of conviction you have for a certain direction, as well as it will allow you to know when to stay out of the market. So the first stage is called the accumulation stage. And this is normally after a big drop in prices. And this is the process of buyers gaining control from sellers. Okay. So this process looks like a ranging market. It normally looks like has a sideways movement. And then there's several little minor phases in here that we won't talk about. But from just a high level, stage one comes after a decline. So the markup phase is stage two. Stage two is a bullish phase. It's an uptrend. We'll learn about uptrends and downtrends, but it's an uptrend when stocks are moving higher, the indices are moving higher and higher. And this is where we want to be buying. We primarily want to be buying, and we want to avoid FOMO, the fear of missing out when it comes to big drops or big sales. So here we're going to buy until the market shows us something different. Stage three is the distribution stage. It occurs after the uptrend where the sellers start to gain control of the market. Those that were holding these long-term buy positions, they start to sell off their positions in order to make profits from what they from the stocks or the contracts that they accumulated as the price was moving up. So the distribution, we'll see some declining movement, but we'll see a lot of ranging movement here. And this ranging movement, we'll talk about why it happens, what's happening during the ranging movement. But here, this is where we won't expect big drops. Sometimes it drops immediately, but we want to be aware of when the ranging period is happening so that we won't try to trade it as if we were in the uptrend or try to trade it as if we were in the downtrend. We have to realize it's ranging. So stage four is called the decline, or some consider it the markdown stage. And this is where the sellers take control. The large aggressive sellers take control of the market and they're selling. And this is where we want to be selling. Our selling strategies, we want to deploy here and be looking for sells. And we want to avoid the fear of missing out on the market returning, because oftentimes we're trying to pick a point to buy, pick another point to buy. And most traders continuously get stopped out by trying to buy against the trend. We as trend traders, our edge is to trade with the trend and sell when the big aggressive sellers are selling. So let's break each one down. Let's talk about the accumulation range. Okay, the accumulation phase. So accumulation is here, right? So this is a sideways movement. Now we're going to talk about what happens here. There are several manipulation maneuvers that we want to talk about here, because what happens here, the large traders, they're trying to shake out the weak traders. They're trying to accumulate all of the orders that they can before rallying the market up high. Because the idea is that they're going to accumulate orders so they can rally the market up, and then they're going to sell it again, right? So it's a cycle. They rally the market up to make profits, to get liquidity, to get orders from the sellers, the retail traders that are going against them. And then they go into a distribution phase, and then they sell off. So this is a cycle that we see, right? So what happens is, you can notice here, this is a accumulation phase, right? Here's another one here. We can see these after these big drops with US 30, we will see an accumulation phase where the market will start to just start to go sideways. Okay. So if you notice, after each one of the after each one of the big drops here, you have some sideways trading here. Okay. Before a big movement up. Okay. So that's sideways. Now look at this one. So it's going sideways, and these wicks right here are a representation of accumulation, right? It's ranging right here. It's a lot of indecision. We can't necessarily see it from here. You have to go to a lower time frame for it to be more clear. But then after that accumulation phase, you have a big rally up to the upside. Okay, so we'll see a pattern of this happening. Drop, sideways movement, and then we have the markup. Okay, so what's happening here is the large traders, they began to create an environment of weakness, right? So it goes weaker and weaker, and what they're doing is, as price is going weaker here, when they see that price has reached a point where they feel they can buy orders at a bargain, they start to do maneuvers to help the price remain weak. So if anybody's selling here, they're acquiring orders, okay? Acquiring contracts, okay? And what they want to do is they want to force the weak traders out. Why? Because when the price starts to rally higher, if weaker traders, smaller traders are in the market as they go up, the smaller traders are not going to hold for a very long time. So when those traders sell their stock or sell their contracts, in order for the big long players to continue to push the market up, they have to buy those orders, right? Because remember, if we go back to the video on the law of supply and demand, in order for the market to go up from one price to another, the aggressive buyer has to agree to purchase the offers at a higher price. That's how the market goes up to a higher point. So they want to shake out those buyers. They want to build a strong position. They want to shake out the weak buyer so that they have a path of least resistance. Okay. So in this phase, the people that are selling, the traders that are not, large supply, they're gonna buy their orders, all the little small supply orders. Okay. And then also what they're going to do is they are going to deploy fake outs. So they're going to push the market down. Okay. You see the market here 2 times. They push the market down. Okay. Here. Push the market down and then rally really hard. Okay. So they start to build up more offers. Okay. They start to accumulate and absorb more offers by creating these fake outs. They start to aggressively sell, pushing the price down. And then the breakout sellers are going to get into these, get into sells. They're going to put stop losses into the market. Okay. So aggressive seller may get in and say, oh, it's melting. I'm going to get in on a sell. See this big bearish candle? Boom, reverses, hits their stop loss. And now that buyer can buy that order, okay? When those stop losses are triggered, okay? So then they do it again. See here? This candle shows that it was pushing down, and anybody else that got in on the breakout, people get in on the breakout, it reversed on them. Okay. So what happens is two things. The breakout sellers, they get in and then the market reverses on them. And then you also have some buyers who they buy a little bit higher here. Okay, so somebody probably bought here, okay, thinking the market was going to go up, and it came down and hit their stop loss, took them out. So they in the accumulation, they deploy a lot of maneuvers to build up their supply from weaker traders, and they don't take a big push up until they test that there isn't a lot of resistance on the way up. That as they push the market up, there isn't strong aggressive sellers that are going to push in the opposite direction. So you'll see that in the accumulation phase, the price will start to rise. So you see it rising. It came down, even though they did the fake out, it stopped here, and then price came up. It didn't come down anymore. It starts to rise. So that's another thing that you'll see. But they're waiting to ensure that there isn't strong supply here, because sometimes there is and the market continues to go down. Remember, there's several different players in the market, even at an institutional level. The big players are also competing. So the few things that the common characteristics of the accumulation, right, is a decrease in volume and volatility as the range develops, right? So big, massive candles, big candles, big candles. And then there are some big candles, but price isn't going anywhere. It's not really going anywhere. And then you see this, look at this, 3 days. Okay, so this entire period was about 19 days. But look at the weakness of these candles here. 3 days of weak, very weak candles. Okay. You'll see false breakouts, bearish false breakouts, bearish false breakouts there. And the bullish volume is going to be much higher than the bearish volume, right? So this big giant candle is a lot larger than the bear candle here. This big giant move is a lot larger than these other moves here. Okay, so these, and then this bearish move is not so big. So it'll take some time for you to. Oh, and one more thing is the development of the rising lows, right? So you see these lows, they're rising. Okay, so that's another sign that the price is going to reverse. So it'll take some time for you to see the accumulation phase, but one of the things that you can do is you can wait on the breakout of the accumulation phase in order to know that the market is going to go into the next phase, the markup phase. So we'll talk about the markup phase in a minute, but if you see, it breaks out of the range and then continues higher. So it was in this box here, right here. It broke out of that, went up, retested it, and continued higher. So now let's get into the markup. Okay. So the markup is the uptrend phase, and this is where we want to be buying. So the markup is the uptrend phase, and when it enters into the markup phase, okay, what we want to do is early on, the conviction will be very high. The momentum will be very high. So we'll have to act quickly. And then we'll continue to buy on the pullbacks. That's what we want to do. We want to buy on the pullbacks. And we'll notice as the trend is approaching the distribution phase, you'll start to see some of the momentum will start to decline a little bit. Okay. But we don't want to try to time it, because the market, what happens is sometimes the buyers, what they'll do is they will see the price getting to a point where there could be potential supply, and they'll take profits. And once they take profits and they see that the supply is, the aggressive sellers aren't there, they'll push the market back up again, and they'll continue that process. So we don't want to try to time the sell. We want to just buy the pullbacks. We want to buy the demand zones when we're going to talk about the demand zones. So don't get FOMO and try to catch the sell. You'll get distracted. Look for the buy. Okay. So now there's a few principles that we want to remember. We want to remember that a trend, once established, is more likely to continue than it is to reverse. So the reason why we think about this is because if you look at the pullbacks during an uptrend, the pullbacks are weak. Okay, so you see this is going down. We'll talk about retracements and pullback. This is going down, but the up movement is stronger. Okay, this goes down, then that up movement is a lot stronger. This went down fairly strong, but the up movement is a lot more. Look at this one compared to this big up move, right? So we have higher risk to reward. We have higher reward by following the trend, much higher potential for higher reward than we do by going against it. So this is small compared to this big giant movement, right? So it just makes sense mathematically that we will stay with the trend and not try to predict the sell. There are many places here that I look at when I look at this this chart where I know people were trying to sell from because they thought it was a good sell area, and then price just violated the sell. Okay, so buy during this time. That would be my recommendation. Ride the wave with the institutions. Okay, so we want to ride the wave with the institutions. All right, so now once the institutions have the interest of pushing the market up, okay, they're interested in the market going higher and higher. Why? Because if the market continues to go higher and higher, their positions that they've been holding on to will give them a larger payout. It will give them a larger payout. So we want to make sure that we are staying with the trend, with the aggressive buyers, because they have the interest of pushing it up. And once we notice they have the interest, then we know where the market is most likely to go. It's a higher probability. It's never certain. Okay. So now we're going to talk about the distribution. Okay. When it's ranging again. So the distribution phase occurs after an uptrend. Okay. So during the distribution, the same manipulation maneuvers that happen during the accumulation happen during the distribution. Okay. So if we look at the daily time frame on US 30 again, before, let's look at one of the declining stages. This area, let's look at one that is, this one ranged for a long time. Okay, 17 days. So if you look at this, they're going to do the same thing. They're going to promote strength. It's going to be ranging, but they're going to promote strength, okay, to make it appear that the market will continue higher, okay? And the reason they do this is because they need buyers to buy the offers that they want to sell. If there isn't any buyers at a high point, in order to sell their shares, they have to go to a lower point. Remember, the market moves aggressively. They sell aggressively. Remember that they sell aggressively. They move the market by going down and getting the next bid. That's how the price goes lower. So they want to have buyers come into the market so that they don't have to push the price lower and sell their shares at a lower price. So the same manipulation tactics are going to happen. They're going to try to force the weak out, because if the weak sellers are in position as the market goes down, those sellers will pull their positions out, and then the big, larger institutions will have to consume those orders. Okay, so the same thing that happens in the accumulation when it comes to the path of least resistance. They'll do multiple tests to see if the price has big demand, big buyers. And once they figure out that there isn't large enough demand, there's weak candles here, demand isn't pushing the market higher, they'll go ahead and implement a big sell. So a few signs that you are in the distribution range is that the volume and the volatility starts to range. There's bullish fake outs. So if you look to the top up here, look at the amount of wicks here. Those are fake outs for people to buy the breakout above. Okay. So this is the distribution. And then next we'll get into the decline. So the decline is the downtrend. This is where we want to be selling. So we want to be selling here. And what you'll see is that in the downtrend, the initial move consists of very large traders. They've built their positions over weeks, months sometimes, okay? But for US 30s, normally over days or weeks. Sometimes it's months. But you see this massive sell candle? This massive sell candle triggers panic. And whoever was holding positions at this support, they start to sell as well. So price breaks and continues, and here this is where we want to be selling. Okay, so that's exactly where we want to be catching. We want to sell with the big, large, aggressive sellers at that point. That wraps up. We're going to talk about the 4 phases a lot more in detail. We'll talk about how to use our edge during the 4 phases. But for now, that covers what we wanted to cover in this video. A little later, we will talk about reaccumulation and redistribution. It's a little bit more advanced topic where sometimes you have an uptrend and then it pauses for accumulation. So they can accumulate more orders and then they continue higher. But we'll talk about that in a later video. Please put your comments and questions in the comment section. See you in the next video.